Currency diversification is actually quite important, and that's one of the benefits of investing some of your money in global assets unhedged. So for instance, most of self-managed super funds and a lot of superannuation funds are heavily invested in Australia, and franking credits are good and one reason to have a lot of money in Australia, etc. But that means that you're invested in the Australian dollar, and the Australian dollar is quite a volatile currency, and it tends to go up and go down. And when it goes down, you're losing value, and certainly you're losing relative purchasing power if you want to buy things from overseas. And we don't make cars, we don't make electronics, so you buy an iPhone or a Samsung, it comes from overseas. You buy any car, because we don't make any cars anymore in Australia, you've got to buy it from overseas. If the Australian dollar weakens, it's actually going to cost you more. So interestingly, having some money in your superannuation fund in overseas currencies actually helps hedge against the Australian dollar falling. Because the Australian dollar falls, the value of overseas assets actually rises. There's also a double benefit here, or an extra layer of this, is if you go back historically and you've looked at when markets have fallen and when we've had pandemics or when we had the GFC or even Wall Street crashes and other things, the Australian dollar has a strong tendency to actually weaken in times of crisis. And so when the value of your Australian shares is falling and the market's falling, the Australian dollar is also falling. And so you're getting almost a double whammy. Your wealth's going down even faster, and particularly your ability to buy things from overseas. Now, interestingly, if the Australian dollar is falling, the value of your overseas assets is actually rising. And so it helps protect that thing. So when you go through when market crashes, that the currency's actually been a great diversifier.